Welcome to the Deep Dive, your shortcut to being genuinely well-informed, packed with surprising facts and just enough humor to keep you hooked. Today, we're plunging into the fascinating world of Hasbro Inc., a company that's been shaping playtime for, well, over a century now.
Yeah, a real giant.
But this isn't just about nostalgic toys. It's about this century-old company on a really ambitious journey.
Sometimes bumpy, too.
Definitely bumpy, trying to transform itself into a, modern entertainment powerhouse. So the big question is, can it actually pull off this pivot, especially now with digital screens everywhere? Or are those classic brands, going to become relics? We're going to unpack Hasbro's strategy, its financials, the forces shaping its future, and we're looking at it through a specific lens, August 31st, 2025. The share price right now is $81.05. We really want to get under the hood here.
Exactly. And that's our mission today, really, to pull out the key bits of knowledge from our sources, give you a clear picture of Hasbro's playing to win strategy. We'll explore that tension, between the nostalgia that people love.
Right, the stuff we grew up with.
And that push for digital innovation, which is just, well, essential today. It's a real balancing act.
A delicate balancing act, indeed. Okay, let's kick things off by breaking down their core operations. Hasbro has really aggressively shifted to what they call a franchise-first model. It's all about unlocking their IP, their intellectual property across all platforms, not just toys.
Right. Movies, games, everything.
And this led to a big reorg, 3 main business segments now.
Yeah.
And wow, the performance differences are stark.
Yeah, really telling.
Let's start with the one most people think of first. Consumer products. This is the traditional toy and game business, what they call the first handshake with us.
The classic Hasbro.
But it's been facing some serious headwinds lately. Revenue was down pretty significantly, 16% in Q2 2025, and it was down 12% for the whole of fiscal 2024. So not great there.
Not the growth engine then.
Definitely not. Okay, moving on. The undisputed growth and profitability engine is Wizards of the Coast and digital gaming.
Ah, yes. Oh, geez.
We're talking huge franchises here. Magic, The Gathering, Dungeons & Dragons.
The heavy hitters.
This division saw really impressive revenue growth, up 16% in Q2 2025 and 4% for the full year 2024.
That's more like it.
And a lot of that success, it's coming from huge Magic releases, record-setting ones, and that digital licensing hit, Monopoly Go.
Right, the mobile game.
Yeah. That alone pulled in $112 million in revenue in 2024, just that one game.
Wow. Significant.
And then finally, their third segment, entertainment. This one's been reshaped. It's more of an asset-light model now.
Especially after the E1 sale.
Exactly. After selling off a big chunk of the E1 film and TV business, now it's really focused on developing content that's directly tied to their core Hasbro IP.
Like Peppa Pig.
Peppa Pig, Transformers. Things that fuel brand engagement. So you've got one segment struggling, another one absolutely thriving, and a third kind of redefining itself.
Yeah.
Does this create like an identity crisis for them? And how do they manage that without, pushing away one group of customers or another?
That is precisely the tightrope they're walking.
Yeah.
What's fascinating here is this franchise-first model really shifts the whole game. It's not just about selling, say, one Transformer toy. It's about creating this whole immersive world around Transformers.
Yeah, it's the ecosystem.
Exactly. And the performance gap you mentioned, it's not just stark. It's like a fundamental challenge to who they are as a company. Wizards of the Coast's success isn't just helping the strategy, it's profit, it's growth. It's driving the whole pivot.
It's the engine.
It really is. It's pulling the whole train.
Yeah.
But that reliance, well, it creates a potential single point of failure, doesn't it?
Good point.
It's fantastic for growth today, but it almost makes Hasbro look like a gaming company with a toy business on the side.
Yeah, I can see that.
The real insight here is how critical it is for them to somehow replicate that ecosystem's success in the other struggling parts.
Okay.
Or they risk becoming, overly dependent on this one very specific, very lucrative niche.
And the E1 sale?
Yes. That was a calculated retreat for sure. But also, frankly, an admission that the big push into film and TV just didn't deliver the value they expected.
Inexpensive admission.
Very expensive. It's a move towards being more capital efficient, focusing the resources, but yeah, it came at a huge cost, which I know we'll get into later.
Right, and what a portfolio of games they have to build these ecosystems around. I mean, these names resonate across generations.
Absolutely iconic stuff.
They sort of group them into 3 types. First, the franchise brands. These are the crown jewels. Magic, D&D, Monopoly, Transformers, Nerf, Play-Doh, Peppa Pig.
Household names, really.
Then you have the partner brands. This includes those really lucrative licensing deals, especially with Disney for Marvel and Star Wars.
Big money there.
Huge. And finally, the portfolio brands. These are own brands, but they get more targeted investment. Like, remember Furby coming back?
Oh, yeah, Furby.
That was actually a top new toy in 2023. And Power Rangers fits in here too.
Got it.
It's a powerful lineup. And it seems to line up perfectly with some really interesting market trends right now. For instance, the U.S. toy market. It actually started growing again in the first half of 2025, sales up 6%.
That's good news for them.
Yeah. And a huge driver of this is the kidult phenomenon.
Adults buying toys.
Exactly. Adults buying toys for themselves. Get this. This group drove an 18% jump in toy sales. They're now the highest spending age group for tools.
Wow, that's surprising.
Isn't it? And it ties into this other trend called nostalgia.
Nostalgia, like new nostalgia.
Pretty much 73% of parents say they're buying toys partly to relive their own childhood memories and, connect with their kids through those shared experiences.
Makes sense.
And this whole kidult and nostalgia thing, it doesn't feel like just a passing fad. It seems like a pretty profound shift.
Yeah.
It could maybe change Hasbro's revenue stability. It gives them this sort of counter-cyclical buffer, an adult-driven revenue stream that's maybe less tied to, kids' fleeting interests.
If we connect this to the bigger picture, Hasbro's deep well of iconic multi-generational IP is just a massive competitive advantage. Think about it. Transformers has like 90% global recognition. Monopoly is 85%.
Incredible reach.
These are the brands that, powered so many childhoods. Those epic Transformers battles you staged in the living room.
Or those Monopoly games that never seem to end.
Exactly. Hasbro isn't just selling plastic figures or cardboard boxes. They're selling a piece of collective memory. So they are uniquely positioned, maybe more than anyone, to capitalize on these kidult and nostalgia trends because the brands already have that emotional connection built in.
That makes a lot of sense.
And within Wizards of the Coast, specifically Magic and D&D, the network effects are incredibly powerful. Well, the more people play, the more valuable the game becomes for everyone involved. It creates high switching costs, you're invested in your collection, your community, it builds serious loyalty.
Right. Harder to just jump ship.
Exactly. And we're also seeing other trends playing out, like the growth in educational or STEAM toys. And licensed products just keep dominating. They make up, 37% of all U.S. toy sales? And that category grew 18%.
So Hasbro's partnerships, like with Disney, are crucial there.
Absolutely crucial. The big question, though, is can they sustain this momentum just by leveraging that existing goodwill? Or do they need more?
Which brings us nicely to leadership and strategy. How is Hasbro actually navigating this huge transformation? The current leadership under CEO Chris Cox, he came in February 2022, seems defined by pretty decisive action.
You came from what he see, right?
He did. And his track record there is impressive. He more than doubled revenue at Wizards of the Coast and turned Magic, the Gathering, into a billion-dollar brand before he took the CEO job.
So he knows the growth engine intimately.
Exactly. And one of his biggest, most decisive moves was dealing with that E1 acquisition.
The one that cost $4 billion.
That's the one. Acquired for about $4 billion back in 2019, ultimately sold off in late 2023 for roughly $500 million.
A massive loss.
It's a huge loss. But you could argue it shows management is willing to correct past mistakes, refocus on their core IP, and, importantly, deleverage the balance sheet.
Yep.
Selling E1 for, almost a $4 billion loss, it definitely shows they're willing to rip off the Band-Aid, but it also really highlights a massive strategic error in the first place.
It does.
How do you, as an analyst, weigh that? The decisiveness now versus the sheer cost of that initial mistake?
That's a really crucial point. And it kind of reveals the mixed legacy of past management, doesn't it? This playing-to-win strategy.
Yeah.
It looks a lot like a calculated retreat from things that weren't working. But it absolutely required acknowledging that massive previous misstep.
Right.
What they've done is slash their SKU, count the number of individual products by over 50%.
Wow, simplifying things drastically.
Exactly. Creating a leaner, more focused company. And their capital allocation shows this focus. They're reinvesting heavily in the core, high-growth WOTC segment. They're doing smaller, strategic tuck-in acquisitions like D&D Beyond.
Okay.
And critically, they're using cash to pay down the debt that piled up, partly from that E1 deal.
Makes sense. But what about the dividend?
The dividend. This raises an important question. Or maybe it's the double-edged sword. Hasbro has this unwavering commitment to its dividend. It's currently $0.70 per share, paid quarterly. They have a 44-year history of paying dividends.
That's a long time. Investors must like that.
Income investors love it. It's a cornerstone for them.
Yeah.
But it's a substantial annual cash commitment. We're talking $390 million in 2024 alone.
That's a lot of cash going out the door.
It is. And it limits their financial flexibility for other things, like paying down debt even faster or maybe buying back shares, which, by the way, they've paused.
Interesting trade-off.
It is. On a more positive note, though, their return on invested capital, ROIC, which basically shows how well they're using their money to make money.
Yeah.
That's shown a really marked improvement. It was down at 3.48% in 2023, but jumped to 10.59% in 2024.
That's a big jump.
Huge jump. And it's a crucial sign that maybe this strategic shift, this focus, is starting to actually pay off where it counts, making their investments work harder for them.
Okay, now let's dig into the numbers a bit more. Hasbro's financial health. It feels like a bit of a mixed signal, right?
Definitely a mixed bag.
Revenue, as we touched on, has been trending down overall, from $6.42 billion in 2021 to $4.14 billion in 2024. Now, part of that is the E1 sale, obviously.
Right, divestiture impact.
Profitability has also been volatile. They boast a strong gross margin, 63.4% in 2024, which is pretty good.
Yes, solid margins on the products themselves.
Their trailing 12-month net profit margin is actually negative right now, minus 13.37%.
Ouch. So losing money overall on paper.
On paper, yes, and that's largely because of a massive $1.0 billion non-cash goodwill impairment charge they took in Q2 2025, related to past acquisitions, likely E1.
Ah, the accounting hit from the reduced value.
Exactly, but here's where it gets really interesting. If you dig beneath those GAAP losses, the story around Hasbro's cash generation is completely different.
Okay.
Their free cash flow, or FCF generation, has actually been a significant strength. It really shows the underlying cash-generating power of the business, despite the accounting losses.
So cash is still coming in.
Yeah. FCF improved dramatically, from just $199 million in 2022 up to $650 million in 2024.
That's a strong positive signal.
It is, but then you look at another number that looks, well, alarming. Their debt-to-equity ratio.
How high is it?
It stands at 12.31, or put another way, 12,231%.
Wow. Okay, that sounds bad.
It sounds terrible, but it's important to understand this is mainly an accounting artifact.
From the goodwill write-down again?
Exactly. That billion-dollar impairment charge wiped out a huge chunk of their book equity, making the debt look massive in comparison. It's not necessarily a sign they're about to go bankrupt.
Right, so context is key there.
Absolutely. Now, valuation-wise, their forward PE ratio is around 16.7. That's actually lower than its 5-year average, which was up near 33.
So cheaper than it has been historically on that metric.
Yeah. And one educational DCF, discounted cash flow model, estimates the intrinsic value at roughly $87.12 per share.
Okay, and the current price?
$81.05. So that estimate suggests the stock is trading, maybe near its fair value, perhaps slightly undervalued. So we've got strong free cash flow, but these big accounting losses and this crazy high debt-to-equity number, how reliable are these signals right now? What should you, the listener, really focus on?
Well, this creates a tale of two segments. WOBC booming, consumer products struggling, and really a tale of two financial stories. Given the ongoing transformation and the huge noise from that goodwill impairment, free cash flow is probably the most reliable indicator of financial health for Hasbro right now.
The actual cash coming in and out.
Exactly. That robust FCF suggests that management's turnaround efforts, the cost savings, the focus, it's yielding real results operationally. What's also fascinating, though, is the disconnect you sometimes see in market sentiment.
How so?
Well, analysts, by and large, are pretty bullish. There's a strong buy consensus. The average 12-month price target is somewhere between, say, $86 and $89.
Okay, pointing towards that intrinsic value estimate.
Right, yet the stock actually dipped a bit, even after beating earnings expectations in Q2 2025.
Huh. So the market isn't fully convinced.
It suggests the broader market harbors some skepticism, maybe about the long-term picture, or maybe just waiting for more proof points. This raises an important question. Why the skepticism if SCF is strong and analysts are positive?
Yeah, what's holding it back?
It could be the lingering shadow of those balance sheet issues, that high debt number, even if it's an accounting artifact, or maybe just broader worries about the economy.
Or maybe insider selling.
Ah, yes. That adds another layer of caution. Institutional ownership is high, around 90%,
Uh,
mostly big passive funds like BlackRock and Vanguard. But if you look at insider transactions over the last 12 months, there have been 19 sell transactions by insiders.
and how many buys?
0 buys.
0. Wow.
Yeah, including a notable sale by the CEO, Chris Cox, of about 27,800 shares. Now, insiders sell for many reasons, but consistent selling with 0 buying, that definitely provides a point of caution for potential investors. It often signals that those closest to the company maybe don't see huge upside from the current price.
Okay, definitely something to keep an eye on. Let's shift focus now to the external pressures. There's a pretty significant geopolitical storm brewing that could really impact Hasbro and maybe your wallet too.
Yeah, the macro environment is tricky.
But first, just quickly on the broader economy. Inflation, it's moderating, but it's still hitting toys. Toy prices jumped 2.2% in May 2025 alone.
Creating that split market you mentioned.
Exactly. People seem to be going for either premium toys or real value options, maybe less in the middle.
Squeeze in the mid-range.
And interest rates are still a factor. Higher borrowing costs mean less discretionary spending money for consumers. Even though the Fed has started cutting rates, U.S. consumer spending growth is still expected to slow down from 5.7% in 2024 to maybe 3.7% in 2025. That's a headwind.
So any consumer company, yeah.
But here's where it gets really interesting and potentially worrying for Hasbro. The most significant near-term external threat, those U.S.-imposed tariffs on Chinese imports.
Ah, yes. The trade situation.
A 10% tariff on basically all goods from China went into effect February 4th, 2025, and the administration is threatening potential increases up to 60%.
60%, that's huge.
Massive. And here's the critical link for Hasbro. Nearly 80% of U.S. toys are manufactured in China.
80%, wow.
It feels like Hasbro is playing this complex strategic game, but the actual game board keeps shifting because of global politics.
Yeah, the impact of these tariffs is multifaceted, and it's genuinely profound. It could be a real game changer for them.
How so? Break it down.
Okay, first, it's a direct hit to profitability.
Yeah.
Tariffs increase their cost of goods sold. That squeezes their gross margins right away.
Makes sense. Costs go up,
Second, it likely forces them to raise prices for consumers.
which could hurt demand.
Exactly, especially if consumer spending is already slowing down, as you said. Hasbro's own management confirmed that if tariffs hit 20%, they would have to pass those costs on to consumers.
So more expensive toys on the shelf?
Potentially, yes. Third, this uncertainty creates chaos in the supply chain. It complicates Hasbro's own efforts to diversify manufacturing away from China, which they are trying to do, aiming for under 40% from China by 2027.
So it makes planning much harder.
Much harder. Retailers might delay orders because they don't know what the final cost will be. It just gums up the works. So this tariff situation, it is without doubt the single most critical external challenge for Hasbro in the near term.
And why should you, the listener, care about tariffs on toys?
Well, it's a perfect concrete example of how global politics can directly hit your wallet. And it shows how a company like Hasbro has to juggle everything from designing nostalgic toys to navigating complex international trade policy.
A lot on their plate.
The big question hanging over them is, how quickly can they really diversify their manufacturing away from China? And what will the cost of that diversification be? It's not cheap or easy to just move factories.
So as we wrap up this deep dive, let's try and pull it all together. Summarize Hasbro's journey. The bull case, the optimistic view, points to a pretty clear strategic vision under Chris Cox. You've got that powerful growth engine in Wizards of the Coast.
Driving profits and cash flow.
Right, generating strong free cash flow.
Mhm.
And those iconic brands seem perfectly positioned to tap into those kidult and nostalgia trends we talked about.
A lot of potential there.
On the other side, the bear case, the pessimistic view. It highlights the ongoing decline of the traditional toy business. There's significant execution risk. Can they actually pull off this pivot successfully?
It's not guaranteed.
The balance sheet still shows the scars from past mistakes like E1. Competition is intense from Mattel, Lego, and countless digital entertainment options.
Sure.
And then you have those critical near-term threats, a slowing economy, and especially those looming U.S. tariffs on Chinese imports.
Big headwinds.
With the share price around $81.05 and that DCF estimate around $87.12, the stock seems to be trading, somewhere near fair value, according to that analysis. So what does this all mean for you as you think about the future of play? Is it all screens, or will physical toys always have that special place?
The story of Hasbro isn't just about toys, or even just about stocks. It feels like a microcosm of some of the biggest tensions in the global economy right now. that pull between the digital world and the physical object.
Yeah.
The power of nostalgia versus the absolute necessity of innovation,
Mm-hmm.
and that constant, difficult balancing act between global supply chains, getting things made efficiently, and the rise of national trade policies and tariffs. So next time you're walking down the toy aisle, or maybe picking up a board game, or thinking about the next big digital game release, this deep dive hopefully shows you just how many complex forces are really at play behind the scenes. Forces shaping not just the companies making these things, but the very nature of how we all play, how we interact with these beloved brands, and maybe even, how much you end up paying for them.